have the pleasure of hearing from Ashota Fatya from Neuberger Berman. Neuberger Ashok is the Deputy CIO for Fixed Income and is a lead portfolio manager on the multi-sector Fixed Income Strategies team. Additionally, Ashok is a member of the Multi-Asset Class Portfolio Management Team, the Fixed Income Investment Strategy Committee, and the firm's Asset Allocation Committee. Prior to his leading roles at Neuberger, Ashok has held senior investment and leadership positions at a number of asset management firms and hedge funds, including Wells Fargo Asset Management, Balyasny Asset Management, and Stark Investments. Ashok started his career as an investment analyst at Morgan Stanley in 1993. Moreover, he received his bachelor's in economics from the University of Michigan, his MBA from the University of Chicago. Last but not least, Ashok is a fellow charter holder. As fixed income is now very much back in the limelight, it sort of had a dormant period there for a while. I think Mr. Bhattia's topic for discussion is something we'll all find interesting and pertinent. So without further ado, please help me in welcoming Ashok Fatya.
Thank you.
I want to get this out of your way.
Yeah, thanks. Well, it's great to be here today, so thank you for joining. I'm going to speak for about 30 minutes, but please, if you have questions while I'm going along, feel free to just, interrupt and keep this as conversational as we can, and hopefully everybody's warming up a little bit from both outside and inside here. But I want to talk a little bit about fixed income, obviously, back on the radar screen for, I think, a lot of investors. And, what I'll try to do is just share quickly a little bit of our macro view, share our view on interest rates, credit spreads, and, what we think, clients should be doing. I imagine we've got a range of folks in here. I know we've got a couple of our clients from Neuberger, but I imagine, there's some financial advisors or those that work with individuals as well as institutions. So, feel free to take this in any direction you want. But I think, the first thing I'll do is just start on growth. And if I were to give you the sort of the headline of where we're going, which is growth slowing globally, it's going to get more apparent in the next couple of months. We're already seeing, I think, fairly strong hints of that. Inflation, which has been the topic that the bond market and all of us have talked about for the last 2 years, is actually going to be pretty predictable next year and is going to go down as a source of volatility of fixed income. What that means for interest rates is, I think, the big debate is not about where this all ends up. In my view, our view, this is going to end up with the Fed going back to about a 3% policy rate, so call it a couple hundred basis points of easing from current levels, with a steeper yield curve, with 10-year treasuries stabilizing somewhere around 4%. That's in our view a pretty strong conviction. That's the end game of this. It's a question of whether we get there quickly or slowly, and I think that's going to be a lot of the debate about next year. And then when we talk about credit markets, the main message there is companies are in really good shape. Defaults and supply and a lot of the things that impact corporate credit markets are going to remain pretty positive for at least the next 12 months. But tail risks, and there's some dynamics there that I think are important to highlight. And then last but not least, I think one of the biggest debates that investors are starting to face is cash. We see it globally. Investors hold a lot of cash, and it's for very good reasons given the yields. But moving out of cash, and we'll talk about some of the dynamics in play and how we think that plays out. But I think first, just let me spend a few minutes on just sort of sketching out the growth outlook. And Paul, I'm going to have to lean over a little bit. I can't, my contacts, I can't even see that one. But the main thing on growth is globally, there's already a lot of weakness out there. We're seeing weakness in Europe. Core Europe, Germany is arguably already in a recession. And I think it's well known that we've got issues going on in China as well. Let me just try this here real quick. Here. Okay. Yeah, maybe I'll try this here. Okay. So, when we look at global growth, the main drivers are, at this point, the weakness in Europe, the weakness in China, which is partly related to the weakness in Europe, but also the China rebalancing dynamics. And what this means is with all the elevated policy hikes that we've seen over the last 12 to 18 months, this, in our view, those two regions, it's more likely to be accelerating on the growth side downward than seeing a rebound. And then the U.S. is a little trickier. The U.S., and I think the way we would describe the U.S. is this is a slowdown. It's going to be, we think, still a soft landing. But 2024 is going to be about moving from the high end of growth within a soft landing context to the low end. Typically, the U.S. gets a recession one of two ways. We either have overinvested in an area, and that investment spending, has to come off, or we have a significant banking issue. We don't see either of those two in play for next year. But what we do see is the way that you typically can get a slowdown in the U.S., which is consumer retrenchment. I think one thing that, when you hear about, oh, we're going to get a recession and a recession is inevitable, skeptical of that view. The U.S. is a $30 trillion economy, and to tell a story about getting a recession, you really have to be able to tell a story for the next 12 to 18 months for why the U.S. consumer is going to see, hundreds of billions of dollars of spending evaporate. And that mathematically, I think, is a very challenging story to tell. So I think you think about next year as not a recession, but as a growth trajectory that is moving from high end of what's a soft landing to a low end. And that probably means something like 1 to 2% in terms of real GDP for the U.S. Next year. A couple of things, I think, just to hit on the consumer. So the consumer has had really 4 big tailwinds coming out of COVID, as people know. The first is the savings. So in COVID, that upper right panel, federal government, a lot of transfer payments, state transfer payments, consumers were able to build up a high level of savings. They've basically drawn that down to normal levels. And these are aggregate statistics, so as you go down the income groups, it's more negative as you go down to lower income. The second big tailwind has been the job market, and I'll come back to that in a second, but the consumer is certainly we're seeing some pressure on the job and the hiring front as well. The other two areas, the consumer started this period with low debt levels. The last few years, consumers have taken their debt levels up to what are historically pretty high levels, and that has occurred, and that's the fourth thing, we've moved from low interest rates to high interest rates. So the 4 things that really have led to this high levels of growth in consumer spending, they've all reversed. And you're starting to see the impact of this, which is the bottom chart, which is delinquency rates for a lot of consumer loans. So we've got autos, home equity loans, et cetera, down there. Student loan payments, as I'm sure folks know, those have resumed really in October. And what we're seeing, I think, the characterization of the consumer is really not a lot of tailwinds at the moment, and default and delinquency rates are returning to what are typically normal levels for the U.S. economy. The next issue, though, which has been the biggest, the biggest support for the consumer has been the labor market. And I would note here that we are already seeing a lot of signs of very typical deceleration that we see in the labor market as we enter a slowdown period. So the first is, job gains have declined. So we're down to averaging about 100 to 125,000 in jobs. We're already seeing traditional things that typically happen in the front end of a slowdown. Manufacturing jobs have turned negative. And interestingly, one of the biggest reasons job gains are remaining high, it's very concentrated in leisure and hospitality. If you think about or see any weakness in that one area, that's been a pretty strong support for the labor market over the last few months. And likewise, as that's translated into wage gains returning back to normal. our outlook and where I think we're going to be, say, in the next 3 to 4 months, is we're going to start to see payroll prints 0 to 50,000 jobs. So the next leg of this over the next 1 or 2 quarters is, it doesn't even have to go to negative payrolls, but we think we're tracking for something that is going to look a lot more like moving from significant job growth to something like flat job growth, with continued pressure lower on wages. And I think the biggest driver of that will be the weakness that we've seen this year in financial services jobs, real estate jobs, technology jobs, both expanding, but also starting to see some weakness in the one area that's really supported hiring, which has been leisure and hospitality. Sorry, kind of mixed up my slides here, but this is, coming back a little bit to Europe and China. Germany and core Europe is already, as I mentioned, in a significant slowdown. Europe, the story in Europe has been the periphery, so some of the non-core countries have actually held up with growth, and actually a fair amount of that has been tourism. But that's an area, too, that we're starting to see a slowdown. And then China, the view here is the property weakness that is filtered, and it's been in the headlines, and happy to come back to that if folks want to spend a few more time on that. But, we have seen, significant property developers go bankrupt, both mainland and Hong Kong. And if anything, that trend is still accelerating. And it's hard to see China being, a driver of the global growth picture, at least over the next 12 months. So that brings us to growth. And I think or kind of wraps up growth. And I think the overall message there is we have been in an environment for investing for the last 12 months or so where we really haven't had to worry about growth. It's been good, very good, decent, but it's not been the thing that's driven markets. We've been very focused on inflation and the Fed response to inflation. And one key message is next year's going to flip. It's going to flip back to something which is more typical for the bond market at least, which is we're going to see the volatility, not around inflation prints, but around growth data and trying to assess both how quick the slowdown is developing as well as the extent of the slowdown. And on inflation, I think main message is inflation is getting to be very predictable for 2024. So right now, for context, I think core CPI, peaked in the U.S. in the whole COVID period, 6-7%. We're down to about, low 4s, high 3s is where we're probably going to print in the next month. So we're still well above the Fed's target of a 2% core PCE level. But next year should bring both lower volatility around those around the prints, as well as a much cleaner move towards the Fed's targets. And I think if you separate what's happened in U.S. inflation, a little bit since COVID is, if you break it into 3 big buckets, on the left panel, left, you saw goods inflation. So, this was everybody's locked in, buying refrigerators, goods inflation goes up to 12%. And it's come back down very quickly. That was a lot of what happened in 2022 and early 2023. I would note that goods prices are actually showing more weakness than we would have expected. So goods prices are back, just a couple months, but they're back close to 0% growth rates or even deflation. Still to be determined, but I think one theme here has been, companies reshoring more to Mexico and other areas out of China, and that's not bringing, quite the same deflationary impulses that China did, but is also keeping a lid on goods prices. A lot of things that are mixed up in that category with autos, and could have a conversation about that as well. But our view is the electrical vehicle transition. There's potential for further downside pressure in the auto sector as well. So, but that is largely that part of inflation is largely over, and we're really debating whether it's 0% plus or minus. We think next year. The second category is what's going to really drive it next year, and this is why it's so predictable, which is housing, owner's equivalent rent. we can, nitpick and argue about this measure, ad nauseum, but it is going to fall, and it's going to fall a lot next year. And that's going to be the thing that really brings inflation numbers quickly back to the Fed's comfort zone. The way we model this, we think that big fall really starts to show up February, March. So we're still a few months away from that, but that's when, so that February, March timeframe is, I think, when we're going to be at, the most risk for seeing some weakness in the jobs numbers coupled with the more significant fall in inflation. And then last but not least, the biggest sort of variable in inflation, is this right panel, which is wages. And I think one of our views this year, which we continue to hold for next year, is the wage growth is going to surprise on the downside. A lot of what happened, and I'm sure we all sort of remember stories, wages are going up and labor's got a lot of power and things like that. Our view is that really what happened in this period was highly related to energy prices, that as energy prices spiked in the COVID area, sectors that normally didn't have wages be very responsive to energy ended up being responsive. And the example here would be truck drivers who got special bonus payments or extra payments when gasoline prices went through the roof. That's not stuff that typically would have happened in this period, and that seemed to impact a lot more job categories than would typically happen. And as energy prices have come off, we've seen wage gains fall, and surprise to the downside. But I think for the debate and how inflation plays out, whether it surprises a little bit to the downside next year, will really be about how the labor market develops. But wages are quickly getting back into an area that is also very, very normal or at least comfortable for the Fed. So let's kind of take this and move it a little bit to markets. So if we think about okay, growth slowing, inflation's going to slow, it's probably not a big stretch that should be a pretty supportive environment for fixed income. And there's a lot on this chart, but I think if we just start by saying, what's fair value for say 10-year treasuries? And the way we think about this is kind of just try to build it up a little bit. I think the one statement is, the financial crisis was characterized, or post-financial crisis, characterized by the Fed getting real yields to a negative level. And that was something that, I think if we look here in this gray area, the 10-year real yield, we spent a ton of time, basically very low levels of real yields, and then, periods of time where the Fed got real yields quite negative. I don't think we're going back to that, at least any time soon. The political desires or power of the Fed to be able to affect that, I think are it's just sort of not on the table. So we start by saying, look, if we think about what's inflation, and say long-term inflation for the U.S., 2.25, which is basically 50 basis points higher than what we saw in most of the financial crisis period. And then we say, look, if you say that's 2.25, and real yields are somewhere between 1% to 2%. And I think this is like a lot of this is not exact science. There's a lot of ifs, ands, and buts about it. But the thing I think you can say about a long-term perspective of the U.S. is 3% to 4% real yields are too high for the U.S. They tend to create blowups. And 0% real yields, we're not going back to that. So call it 1% to 2% real yields, which, high debt loads, things like that, seems like reasonable enough. So if we get to 2.25 10-year notes, or 2.25 inflation, add 1% to 2% for real yield compensation, that's sort of 3.25 to 4.25. But the big wild card, I think, is what's really kind of come back and we've heard a lot about over the last period, which is this measure of term premium, which is, you can think about it, a lot of different ways, but, think about it as in compensation for uncertainty about inflation tracks, uncertainty about what real yield is appropriate. This is something also that in the financial crisis, the Fed was very successful at pushing to very negative levels via the bond buying. And I think this is something that's, again, pretty consensus, but it's coming back. The government financing and deficit needs, we should have some term premium. But, whether it's going to be 100 basis points, 200 basis points, 50 basis points, I think that's something we're going to be wrestling with for a period of time. Our best guess is where this settles, and I mentioned sort of a 4.25 10-year note earlier, is we'll see something like 2.25 inflation, maybe 1.5% real yields, and then add on a little term premium, and suddenly you're at a sort of a 4%, 4.25 equilibrium 10-year yield. The risk to that number, I think, is more, oh, sorry, go ahead.
How do you factor, if at all, in the effect of issuance on your forecast? Obviously, there's a lot of issuance that's in the pipeline.
Yeah, and that,
So I'm just curious how that affects your forecast.
the issuance comes into that term premium. That is, that is one of the things that really goes into thinking about what is the compensation for the government's financial budget or financial posture, as well as the supply dynamics. Because you're absolutely right. This supply and the government's financing is going to be a big issue because, in the financial crisis, our deficits were bought by three entities. It was bought by the Fed, and they're not buying it. They were bought by China, and for a lot of reasons, they're not buying it. And then Japan. And Japan will buy bonds again, but with hedge costs and the dynamics of their yields, they're economically not incented to do it right now, but they will come back. But I think that supply of government bonds, now there are things the Treasury can do to delay the day of pain on that. They can issue more in short maturities, and they're doing a little bit there. But I think that idea that there is more government bonds coming into the private sector's hands is the reason that is one of the big reasons that number goes positive, and you think about somewhat higher levels. So I think the other thing I would just say on this is, so if we think about the Fed's path, and I mentioned this at the front end, which is, we think the Fed, I think you can say a few things about the Fed's hiking cycle to 5.25, 5.5, which is the current rate, which is first, typically in a Fed hiking cycle, the Fed overdoes it. Typically the last 1 to 2 hikes get viewed by history as unnecessary, and I think that's probably, going to be reasonable for this time around. The second thing is, I think there's good reasons to think that the Fed has gotten too restrictive. And part of it's just how the Fed has conducted policy in this period. The Fed has said, we are going to conduct policy based on the current data that we see. We're not going to take into account where we think the economy's going, but just what we're responding to right now. Well, it takes a while. I mean, I think, we're all probably seeing it in daily lives, that the impact in interest rates, it takes a while for banks to start offering more for savings accounts and deposits and impact flows. It takes longer for the interest rate expense to start showing up to households and corporations, but it does. So when you conduct policy, by definition, for the current data, you're probably going to over-tighten, given that you're not thinking about the next 6 months or so. So I think there's a pretty good case that what's going to occur in the next few months is the Fed's going to transition to thinking a little bit more and talking a little bit more about, hey, let's conduct policy thinking about where the puck is going, not just where it is. And that's also, I think, an argument for why 5.25, 5.5 is, a couple hundred basis points too high. So the end game of this is, again, thinking about a 1% type of real yield, is the Fed, is thinking about 2% inflation, 1% real yield. That's an equilibrium policy rate, roughly of 3% plus or minus. It's not to say the Fed's going to get there next year, but I think, if that sort of is the end game, every day you hold cash at 5.5 to 5 and 3/8, it's a decaying asset. You may earn it for another month, you may earn it for another year, but the incentives as time passes to move that cash and lock in slightly higher yields, I think will just end up growing, as days and months and weeks pass. And, depending on how weak data is, and, there's a lot of uncertainties here, is it impossible the Fed gets to 3% faster? I don't think it should be like your base case, but I wouldn't discount that possibility too strongly either. So, let's see, a few other things. Let me just talk about credit markets and such real quick. So, IG credit. For those that maybe don't follow fixed income on a day-to-day basis, we're in an environment where interest rates, relatively high, at least by, last 15 years of standards, and credit spreads are generally pretty tight. So an investment grade corporate spread, on average, say 100 basis points right now. In periods of distress, that can get out to 250, and in periods of, some of the tightest levels we've seen have been, 80 to 85 basis points. So pretty close to the tightest levels. And I think, the way we are thinking about credit markets is if next year is about a soft landing, even if it is a slowdown, that's probably still a pretty good fundamental environment for corporate credit. It's not an environment we should see a lot of defaults, not an environment where we should see a lot of downgrades. It's okay. But the big change that's happening is that corporate credit used to be very insulated, and I say the last few years, it was very insulated from the growth outlook. When we came out of COVID, corporate America basically, termed out all its debt, so it didn't face a lot of maturities, cleaned up its balance sheets, raised cash. And so corporations were in such a good shape in 2020, 22 to 22, that even if you had a slowdown, you didn't have maturities or enough pressure to force downgrades or defaults. What's really changing now is companies are going to be sensitive to, we think, to the economic outcome. So if you get a bit of a slowdown, you can see maybe, in our numbers here on the left panel, you can see that, you can get a little bit of widening in corporate spreads. But the big change in the corporate markets compared to what we've all been used to the last few years is if you do get a recession, there's tail risk again in credit markets. And so when our advice to investors is, you can be very overweight and, high concentrations in corporate credit if one or two things. First, you have a high confidence this is a soft landing and there's not going to be a recession. Or you say, look, I know there's some tail risk, but I'm going to go reduce my equity exposure, or I'm, thinking, at least I'm aware of this, and I'm doing something else in my portfolio to mitigate it. For us, as fixed income portfolios, we've taken the stance that, we've reduced these allocations. So, just to put some numbers in our flagship types of products where, 2 years ago we had 40% in high yield and 25%, 30% in investment grade credit. Those numbers are both closer to 15% today. And I think it's just a recognition that spreads are tighter and there is tail risk and uncertainty. Uncertainty about the economic outlook it can lead to wider spreads. But, again, probably contained. We've got a bunch of stats here which, basically make the point that, we're not entering this in a period where corporate America is got very weak credit metrics by any stretch. One other area that we do like, the municipal market. So this slide speaks to, taxables, but tax exempts also. For anyone in here who's maybe works more with individual investors, we have started to see some significant movement into short to intermediate tax exempt types of securities. Some of the longer term, municipals, certainly off the cheapest levels, but those still look, I think relatively attractive. Particularly, you do the tax adjustments for some of the higher tax states. It's still pretty compelling for cash to move into the municipal market. But one other area is some of these taxable munis. So, I think one theme that will also start to be a little more pervasive is, in the 0% world, if you wanted yield or, your opportunity set, you were really forced into, a lot of corporate credit, high yield, emerging market allocations. And, the change in the yield structure is meaning things like taxable munis, and securitized credit can be a part of portfolios where, 3-4 years ago, the yields just sort of didn't make a ton of sense. Let's see here. So if there's one big change that I think also is worth highlighting that's coming out of this and an opportunity is the securitized market. So these are mortgage securities, asset-backed securities, commercial mortgage-backed securities, and I think just the structural change that's happened or is going to happening is if we look at who's financed the mortgage market, homeowners in the U.S. Since the financial crisis, this one's been on two entities. Again, the Fed buying mortgage-backed securities for its balance sheet, and then the regional banking system, which originates and held a lot of the mortgage securities for homeowners. Well, again, the Fed's not buying these securities anymore. They are rolling off that portfolio. And the regional banking system, just given pressures it's facing, they're not providing capital near term either. What we're actually seeing regional banks, try to offload, books of mortgages because, if you're a bank and a regional bank with these underwater securities, your incentive is just, survive to the next day. And, the equity market, is rewarding transactions where you clean up your balance sheet. So what I think this means for the next period is that mortgage finance in the U.S., which has been regional banks and the Fed, the private sector is going to have to do more of it. And that's, people like us, pension funds, homeowners, foreign investors. So, one thing we're doing is, we are adding staff and really this is an area that, we've always had a presence in, but I think when we look out the next 2 to 5 years, the opportunity set and our client interest in it is only going up. And so we're, putting our resource allocation, I'd say pretty heavily into this area. And it's an area that can solve a lot of needs. It can solve investment grade, high quality needs. I'll come back to that. But it also offers, mid to high single digit types of opportunities and things that are a little riskier, commercial mortgage-backed securities, asset backs, et cetera. So this is one, for anyone who's in fixed income, I'm sure you've seen or heard about this ad nauseum, but I will briefly review it, which is the agency mortgage market. So these are securities that, they're quote unquote guaranteed by Fannie Mae, Freddie Mac. This is not subprime. This is a mortgage that, is sort of sub $700,000, 70% LTV, pristine credit. You will get your money back. But what's happened is, these securities have gone from, with low, mortgages, we read the stories about, homeowners with a 3%, 4% mortgage. Those securities that trade in the market have gone from, par to 70 to 80 cents on the dollar. And at the same time, the spread levels have blown out or gone certainly pretty wide. This is a very unusual setup, which is the usual negatives of this market, which is getting your prepayments or getting your money back faster as homeowners prepay. It's actually the opposite. At a discount dollar price, getting early prepayments is actually a good thing. And this is an area that I think the market is really right now in a transition phase of trying to find out, because private sector investors, we have had limited allocations to this area, for the last 15 years. And, when I referenced our allocations to high yield and investment grade, these are securities that have gone from 15% of portfolios to about 51% of portfolios. So we have been adding a fair amount into this area, which is, maybe a bit of a statement of the value we see here. And so I think this is going to be an area, and these are AAA securities, you're not arguing about getting your money back, et cetera. And, But this is, I think, for those that do fixed income, core plus, securitized strategies, all, different flavors of trying to capture this opportunity. And then, real briefly on high yield and loans, high yield markets, a lot of the similar trends to the investment grade space, which is, leverage levels are relatively low, coverage ratios have declined. I think one trend that's worth highlighting is for some of the, issuers that are maybe a little on the lower rated side, maybe owned by private equity or those types of owners, where companies have gotten in a little bit of cash flow trouble. A general statement, we've seen sponsors put some more money into the capital structure, so defaults have remained, relatively low in this space. The other trend, I think, though, that we're seeing is, fundamentally challenged businesses. So here, I'm thinking about like wireline phone companies, things that have been in structural decline. We're generally seeing those declines accelerate, and the bond market's not having a lot of patience for that. We're also seeing businesses that, on the high yield side that have a lot of assets, but maybe a little lighter on cash flow. Bond market's a little bit more reluctant to be favorably viewed on those types of securities. But overall, it's, as you see in returns, it's been a good period for high yield. The other thing, just I think that's, that we talk about a little bit is the maturity wall. Companies in the high yield space, which were facing, maturities in 24 and 25, they've continued to extend. They've used this period of tighter spreads to extend maturities. So not a ton of risk there either. I think overall, high yield, non-investment grade, these have they have a place in a portfolio. The return opportunities here are, 7 to 9%. It is setting in our view, a bit of a hurdle rate for equity markets again, and we are seeing interest in, out of equities into some of these, lower rated types of bond strategies. And then, last thing or two last quick points before happy to take any questions. Is, emerging markets. And emerging markets remains, I think, that's probably the trickiest, area of the bond market where, a lot of the yield is coming from some of the riskier names. So this is, if we break the emerging market space into two big buckets, one is some of the highest quality issuers. So these would be countries like, Malaysia, Singapore, Thailand, Taiwan, those types of places. Yields are pretty tight, or spreads are pretty tight. And then you've got the basket of countries and issuers where yields are higher. And this is, Argentina, Sri Lanka. These are names where there's defaults, a lot of volatility. The yield is really in that second bucket. So, our advice on emerging markets generally is, it can fit for a special situations, a very opportunistic type of allocation. But as a broad, and I think, one thing I see with clients is, clients who have not allocated to emerging market fixed income, the returns last 10 years, I think 9 out of 10 years, it's underperformed other bond sectors. Clients who have been, underweighted or not owned it, they're saying, hey, that was a good decision, I don't want to revisit it. Or if you've had some investments there, it's performed, but is underperformed. Clients are not looking to increase allocation. So I think this is a trickier one, and we are certainly seeing that bifurcation mean capital sources for the riskiest names is moving a little bit more towards that special situations or even distress type of capital provider. And then last, thing I will just highlight, before wrapping up is just the math of fixed income, which is as yields rise, the break-even rates to lose money in fixed income, they just continue to go up. So this is at this point a little bit dated, but if I take sort of the 5-year Treasury, yields could go up 100 basis points from here, and you still have a positive return. Now that will underperform cash, but it will still be a positive return. And likewise, though, if you start to see a fall in yields, there is, and this is, just bond math, fair amount of total return appreciation. And I think this is the one thing that's a little bit self-limiting about fixed income sell-offs, which is as yields rise, the break-evens are, just get harder to achieve. And I think, what we, basically see happening is, money that is moved, into cash to take advantage of these yields. As the economic data and inflation data starts to be well behaved, the incentives and pressure to move that into some sort of short maturity fixed income will be the first phase, and suspect that's going to start happening sooner rather than later. So with that, maybe I can just pause and see if any questions.
Sure, I had a question. Going back to your discussion on growth, both in the U.S. and some in Europe, you said a big part of that was tourism, travel, all that. So that's a big part of the growth forecast in both Europe and here. Do you follow that? That's pretty important, I would think.
Yeah, and I think, maybe I'll just take that as an opportunity to expand a little bit. I think, Europe, the Ukrainian war, it has such a bigger impact. Like, I sit in Chicago, and it feels like a lot further away. Well, it is further away, but when you go to Europe, I mean, the first thing people are talking about is the impact that has had on economies, on Germany's resource reallocation, food prices. The impact of that on the growth and the psychology of investment, I think I don't appreciate it as much until you go out and meet with European clients. So I think that has been an overhang. And the flip side of that is something, and I think something that gets some sort of end of the war over there, likewise would be I think a pretty big positive for the growth outlook. But that is really that and China, because China's biggest export partner is not the U.S., it's Europe. And so the weakness in China, Germany has gotten hit on two fronts. It's gotten hit on having to redo its energy production and policies because of the Ukrainian war, and then it's gotten hit with the China slowdown. And that German weakness has dragged down, France and some of the other core countries. And then the periphery, as mentioned, has benefited from, very above average. And I think we all probably feel this or see this in your daily lives, which is you had 2 years of travel get all crammed into one or two periods, and it's led to, inflows from sectors that are already pretty important for places like Greece and stuff to even higher levels. So we do track it. I would say for the U.S., it's, we see it mainly through the payroll data and what we hear from companies. And I would say we're not hearing it enough to say that the hiring in leisure and hospitality in the U.S. is going down next month. But I certainly think that my own view is that is coming, but it's not there. But it is, long-winded answer to say it's something that we follow. But the European situation has got a few more, few dimensions. And I think the belief is, and what the market expects is, the ECB's policy rate is 4% right now. So they've gone from negative rates to 4% in pretty short order. And the bond market believes they're coming down to about 2.5%, and over the course of the next 12 months. And that is, I think, it's largely a reflection of this weakness starting to pervade a little bit more throughout the region.
I was just wondering if you could talk a little bit more about mortgage prepayments and how far do mortgage rates need to fall to get back to what you might think of as an average prepayment speed?
Sure. I could talk about mortgages for half an hour, so this is my favorite topic, so I will make sure I don't do that. So I'll start with a statement, which is mortgages prepay typically around 2 to 4% a year. Always happens, irrespective of the economic environment, and that is life events, which is people die. People have to move for non-economic reasons, divorce, those types of things. And there's also amortization. So you add up and say, whatever the mortgage, interest rate is, you can expect 2 to 4% of it to prepay every year. And that is actually what things like 3% mortgages currently are prepaying at, and what you expect, what the market expects. Now, when mortgage rates are, when there's an economic incentive to refinance, those prepayments can go up to 60 to 70% without any problem. The system is quite efficient about refinancing people. So, but to answer your question is, I think that 3%, to get an economic, incentive to say refinance a 3% mortgage, you would have to probably be back to like a 2% type of treasury rate. So I think seeing that type of move, it's not our base case. But I think the opportunity in these is, look, if you're buying these mortgages and they're priced for a 3% prepayment rate, what's your downside? It's not going to be a lot lower than that. And I think you can tell a story that maybe you get a little positive surprise on that, which is, look, if we get economic weakness and the labor market forces people to move for job opportunities, that's how you can get a little bit of acceleration in prepayments. But the math of these is such that you don't need a whole lot. I mean, if something's prepaying at a 3% rate and you even go up to a 5 to 6% rate, that adds like 30 to 40 basis points of yield to these securities, which is for us in the bond world, that's like super exciting. So, yeah. So.
Can you expand a little bit on why in your three-part inflation analysis you think that housing or OER is going to be down?
Yes. So housing and OER is a delayed measure. So just the way the Bureau of Labor Statistics puts this together is they basically try to look at rental markets and equate what's happened in rental markets to what's happening to home prices. But they do it with a lag. So it happens it doesn't show up into the numbers until about a 6 to 9 month or even a little longer lag, just the way the data is formulated. And so what we are off peak house appreciation and peak rental rates, right? I mean, in some areas, those not a lot of areas, but some areas, house prices are actually going down, rental rates are going down. More areas, it's just sort of flatlining. So what we're going to see show up in the data for next year is really just what happened in this year with housing price and rental prices stabilizing and starting to fall, just getting caught up to the data last year. It's one of the things that's also happens, it happens just as an aside in auto prices. It takes usually 2 to 3 months for what happens like on a dealer lot or a wholesale used car lot to factor into the numbers we see. And I would say this is not a controversial opinion. Like if you look at and go Goldman Sachs or anybody's, pick 5 people, what they think will happen to this, all of the forecasts are going to be pretty tightly around each other because it's not something that's difficult to forecast.
Can you just talk about that a little bit for the yield curve into 2024?
Yes. So the yield curve, and I don't have a great slide for this, but yeah, so the short answer is I think the yield curve is going to steepen. So we are positioned, I would say on a scale of 0 to 10, 6, 7 in 5s, 30s types of steepeners. And so I think the reason for it is, look, if the Fed if we're correct that the end game of this that is a much lower funds rate and 10-year yields which are roughly around 4%, that argues for a steeper yield curve. I think second, the tail risks on the curve, if it comes back to the question on government finances and deficits and stuff, is that if we saw this right in I guess September, October, panic about government finance and bond supply, that becomes not just a 1 month or 2 month event, but a permanent feature. That's how you also end up, I think, with a steeper yield curve. The biggest challenge with it right now is that typically, a curve steepener can be, right now it costs you. It's a negative carry type of position given what's priced in. So timing of that is tricky. The way we've been approaching it is, own things like 5-year mortgages, 5-year corporate credit, which provides a little more income to offset those carry features. I think the two risks to it, and the way the curve stays very flat or even inverts from the current levels. The curve has gone from 5s, 30s. It's steepened out already about 40 basis points or so from the lows. The way that's wrong is, one, the Fed gets very recalcitrant. So we see the economic weakness, but the Fed is like, we're not easing, go away, market, we're not doing it. In which case the market will say, okay, if you don't want to ease today, that just means you're going to have to ease a lot more tomorrow. And, the bond market will invert the curve further. Or the second way is, I think, the fiscal position in the U.S. suddenly gets a lot better. Like, one interesting theme going on right now, Germany. Germany's going through fiscal retrenchment. And it's really hard to see in the U.S., but, I think, but if you start to or see policies where federal government is, cutting spending or even cutting the growth rate of spending, those kind of things suddenly make maybe the term premium argument less relevant and get the curve flatter.
Any thoughts on contagion dynamics if we have, slowing growth in Europe broadly and in China? Any thoughts around that, which might affect U.S. markets?
Yeah, to be honest, not a lot. I think this if we're kind of correct roughly on this, that this is a slowdown, it's not recession, it's not deep, it's just whatever. It's not a disaster. I think it's hard to paint a story where this gets really, really out of hand. I think the way it gets out of hand is, central banks, see we start to get negative payroll prints, and inflation's falling and the central banks don't do anything. I mean, you can certainly see some there. So I think that's I think that's kind of low probability, personally.
What do you see as the biggest risk sector in the you mentioned what this is going about and everything that's going on in the U.S. But what are your views on the biggest risks right now in these sectors?
Yeah, so I'll give you two. One is, I think, the private markets, so for private fixed income. Because, the transparent, we can go through for the public markets and give you default rates are 1.6%, and here they are, and we know what's going on. Private markets, is for anyone in here who's doing the private markets, it's a lot of anecdotes, and it's hard to know exactly. When we talk to our private teams, the one thing I come back to is, private defaults in the private sector would have been higher this year, except for capital injections from sponsors. And that can go on, that can go on for a period of time. You can inject equity, you can put in PIK structures and things like that, but it doesn't go on forever. So on one hand, I think there is some risk that we start to see defaults rise in the private markets. Now, the problem with that, or the reason that's not probably a systemic risk is, the private markets or private debt markets, they're largely owned by investors that should own them, which is you've got locked up cap or long-term capital, maybe not as much leverage. So, you might see a reduction in returns, but this is not like a 20-to-1 levered bank owning something that is suddenly experiencing defaults. So I think that's definitely one area. And then the second is, and if this is being recorded, probably should edit this out, but typically at the end of these cycles, you often see a fraud, and I don't know what it would be, but WorldCom, Enron, you get these things that happen, and something is like complete surprise, and it wouldn't shock me if there's some big fraud out there that we don't know about. So maybe we zip that one out, but yeah. So that's kind of a facetious answer, but I will say what we have asked all of our research analysts to do is like complicated balance sheets, things that are opaque, young financial management teams. Those are things that we're being a lot more just skeptical on, even if we can't like see an immediate trigger.
Yeah, Jim Geno's just hung up his gloves.
Yeah, I saw that. Yeah,
Contrary signal.
yeah. So, all right. Well, thank you. Thanks for inviting us. Great to see everyone, and have a good afternoon.